I want to kick off with a question for Catherine. We in the ESG space, we all know that the data sets and with the E part of ESG are very well developed. There's a whole array of standardized data out there, but that's less of a benefit with the S part of ESG. Can I just, in terms of framing this conversation, can I ask you, how well served are we by the S data right now? What do you see as the most useful data sets, and where do we need work?
We are not as well served as we need to be and ought to be by data on the S of ESG. That's a fact, but it's also one that I think is evolving and shifting very positively and very quickly. So I'd speak specifically to very important developments underway thanks to the European Commission, which has set out that it intends to develop a very ambitious new framework for corporate sustainability reporting, which will be mandatory on companies in the European Commission. It's already started to publish what those standards will look like. So first off the track was some really interesting data on workforce reporting by companies. But there's more coming down the line. And what's very interesting about that is that it's not only inviting companies to report on S factors as they materially affect those companies from a financial point of view, but also looking for corporate reporting on a standardized basis on companies' impacts on society, so-called double materiality. So that is a major and very exciting development, which should transform, actually, at least the quality of data on European companies, and I think it will set a global standard. Meanwhile, there are some really important voluntary initiatives led by investors. We're involved in one called the Workforce Disclosure Initiative at ShareAction, and that's collecting and improving radically the quality of data on workforce issues. So things are happening, and the demand that investors are showing for data on S is really, I think, going to help. But the fact remains that the quality is very patchy. Companies tend to disclose information on a bit of a cherry-picked basis. They tend to tell nice stories about themselves, and that's not, comparable information that investors can really rely on. So there's a long, long way to go, but what's critical is that investors show the appetite and they signal to regulators in all regions of the world that they need comparable reporting from companies on their social risks and social impacts.
And SoVonna, just to pick up on that point, so Catherine talked about the European Commission being something of a trendsetter here, and potentially also setting the agenda for other countries around the world. Are you seeing the same momentum in the US? Question number one. And secondly, how big of a problem is it that we don't really as yet have a standardized model for the S? Again, as I said at the top, the E part, you look at TCFD and other sort of pressures coming for better disclosure, more unified the data, in the climate space, but in the social space, in the S space, how much of it is a problem that we have this lack of a standardized model?
Yeah, I think there is definitely, if you look at ShareAction, there's definitely investor, push to make sure that there are better data sets available to them to make decisions, right, about what companies they want to invest in. I also think that there are some nonprofit organizations here in the U.S. who spend a lot of time qualifying and ranking companies such as Just Capital to make sure that they are able to provide to the public a point of view on how companies are performing against their sort of public measurements. But I also would say that it does require intrinsic motivation by companies to ensure that they deliver that information to people, and they do that in somewhat of a what would I say, like a voluntary basis. They should want to demonstrate their worth through exactly how they manage to live up to the S. Because I think if you think about E, S, and G, there isn't an E without an S social co-benefit, right? And G almost appears to be table stakes for any company. So they have to have good governance. So it's incumbent on a company to really think about the anchor here, and the anchor is the S, because it's all centered around the people. And that will translate into profitability. And that's going to be the ultimate data, right, that proves out a company's worth. So I think the external factors that sort of contribute to what forces a company to do right and do good should not be the only way that we get the data. Is that someone tells them they have to. I think it actually has to be motivated internally to want to share that data to only make it better for, all the stakeholders involved.
But if we're not seeing that momentum now, or if we're seeing a certain amount of foot dragging in terms of disclosing that data, what will it take to get companies to give us more information, to give us more data on these S factors?
Well, I think we're already starting to see it, right? Which is that this is a tight labor market, right? It's probably one of the tightest we've ever seen. So there is actually a rebellion by employees around what it is, the standard is that they're willing to work for. And so I think when you start to see the labor force speak with their feet, and say that they are not accepting kind of the current standard, it's going to force a lot of participation, right, in trying to make that different. So I think shareholders definitely have a responsibility to forcing the issue, but I think they're not the only stakeholder in the process. And I think employees are starting to say that these are the companies that I will work for because they have a particular interest in people and the planet. And they are going to be the ones who actually drive the profitability of an organization. So I think that there's a lot of people who hold a particular, stick in making sure that these things actually happen.
Mm-hmm. And Julie, one of the things we want to get at in this panel is this question of how the data is being used to make a difference. The data and the models that we have now, when you look at how companies are being pushed to change behavior, is that actually really coming from the S data? How useful is the S data in forcing companies to change? Or how much is it really coming from some of the things that SoVonna talked about, pressure from the real economy, pressure from the real world? Like, how useful is the data proving to be in actually getting companies to change behavior?
So, whilst there continues to be constant disclosure or data gaps, I also do think that there's much to be positive about in terms of the direction of travel. And so when we look at a confluence of factors that are occurring, you have one lever, which is what we're seeing play out, as Catherine touched on, in regulation, not just in Europe. And so clearly that's providing what I would call a tighter precision tool around these measurable, quantifiable, decision useful information. So, that will, I think, permeate to other markets as well. And we've seen the catalyst come out of Europe with not just TCFD, but all the taxonomy and the disclosure regulations. It's very intentional that whilst the first focus is environment, it is shifting to social and this notion of this do no significant harm. So one confluence is regulation. I think the second confluence is around standard setting. And so at Northern Trust Asset Management, we're members of the Investor Advisory Group at the Sustainability Accounting Standards Board. Now, what we've seen over the last few years, and in my prior firm as well, is we're seeing a coming together of certain industry bodies. The International Sustainability Standards Board, which was announced at the recent COP, that houses the SASB standards. That begins to get towards a global framework of harmonization. we believe it's going to be a game changer. I also think it's very important, though, for investors to stay very mindful of the different regulatory kind of requirements between not just Europe, UK, launching their own disclosure requirements. And what we're trying to get at is globally this unified framework. So you have these levers that are actually coming together to create an environment of this greater precision for investors to then go to corporates on engagement activity. And so part of what we tend to do from an investment management lens is look at these various frameworks. So we look at SASB in terms of that industry specificity to really identify for us, well, which industries are the most exposed to human capital issues? What's the type of data that we're looking to get out? We will align with frameworks such as the Human Capital Coalition frameworks, which we are members of. And the mission there is really, how do we promote human capital disclosure, particularly around diversity, gender, race, ethnicity? There's a lot of disclosures around gender. The race and ethnicity is data that we generally find isn't quite there yet. And so the role that an asset manager and an investor has to play in this is, well, if we are holders of that capital, then how do we bring to bear in the conversations the type of information that we're looking to disclose? And we are being informed by the likes of SASB, by human capital management frameworks in looking for workforce disclosure data. The second element is, well, then what do we do with that information that we're trying to push for better disclosure and better metrics? Well, it's also about how we begin to incorporate that within how we measure our exposure to these companies to try to identify leaders from laggards. Because once we're able to provide a scoring mechanism to look at this type of data, we're able to just introduce another signal in terms of how we rank securities and how we identify those securities that are perhaps on a disclosure basis not quite there, that we can then take forward in our engagement targets and have those discussions with companies. The other third lever I would highlight is it's also our own selves. We're a corporate, we're an organization. And so something that we advocate for is the disclosure around ethnicity, race, and gender. We do that ourselves, and we will support shareholder resolutions that ask for that as well within the companies we're invested in.
Mm-hmm. So that sort of leads me to the next question, I guess. Should we see, in terms of, how companies are being pushed to better disclosure, to better practices, should we see the glass as being half full or half empty? And perhaps I'll direct this one to SoVonna. I was looking at some data pulled together by my colleagues in Bloomberg Intelligence that show that in 2021, 35 shareholder proposals in the Russell 3000 sought either better diversity reporting, diversity on the board of directors, or a third-party racial equity audit. That was nearly double the number of diversity proposals in 2020. And also, the average shareholder support for these resolutions averaged about 41% last year, up from about 25% in 2020. How should we read those numbers? Is this a cause for optimism, or is it a rather depressing, are they actually depressing examples of how far we need to go?
Look, I think any upward mobility on disclosure as it relates to race and gender is a positive, right? So any time that you can see better data and better disclosure. The depressing part of that is, yes, we have a long way to go to actually see demonstrable difference, right? So I think what we cannot do is get lost in the data. Which says that here's actually the information. That's not really where people live. Where people live is how does that condition actually affect my performance, affect outcomes for me, right? So I think the data in saying that it's important to have diversity and inclusion does not necessarily set the standard for equity, right? And actually upward mobility and success. And so I think that what I'm not disillusioned by is that there's this information that's out there that tells us, oh, here are the numbers, but it doesn't really get inside what is really happening and what are the practices that are going on within organizations that keep people from actually advancing and really getting to, a place in which they feel that they are truly contributing and actually having a voice in the design and in the actual, company's decision making. So I think that there's data, and then there's real impact.
Mm-hmm. And Catherine, is there a risk? So we've talked a lot about how the relatively poor quality of the ES data, signs of optimism that it's getting better. The European Commission and others are setting the agenda here, creating some momentum here. But how much is there a risk that investors perhaps use the poor quality of the S data as an excuse not to lean in on the S issues in the way they might do on, say, the E part of ESG?
Yeah, well, I think that goes to the point SoVonna made earlier, which is, do investors really care about the social performance of companies? And I think some do, and many do not. So, the correlation between performing well on S metrics and delivering, more robust, resilient, and sustainable financial returns is a bit wibbly wobbly, to be honest. So it's not always clear that investors are totally motivated to drive companies in the right direction. There's also another kind of confusion, I think, which is that some of the biggest companies in the world are better equipped to provide disclosures. Let's take Rio Tinto, actually quite good when it comes to disclosure of data relative to other companies in the global mining sector, but recently exposed as having an absolutely appalling problem with respect to women in the workplace, sexual discrimination at work, and sort of pathways and progression for women. So I do think there's a risk in saying just because a company discloses better than its peer group, that somehow it may actually have fewer problems underlying in terms of its treatment of various stakeholder groups. So there's quite a minefield here, actually, and one of them is around the motivation of investors. You've mentioned, which is absolutely right, John, that there were much more support last year, which is to be applauded, in terms of votes for resolutions for shareholder proposals calling for better disclosure. But actually, we found when we analysed votes last year that resolutions that actually called for substantive change and improvement in how companies manage their stakeholders got really poor support relative to resolutions calling for better data and disclosure. So there's, I think, a real challenge around how strongly motivated are institutional investors to act on these issues. But what gives me hope and optimism is that I think underlying investors who institutional investors act on behalf of, ordinary people with savings and pensions, are very committed and interested in companies treating their stakeholders well. That always has very strong support when you poll members of the public about what would they like their pension fund to be focusing on from a stewardship perspective. So I think as the industry is forced to be a bit more consumer orientated in terms of really engaging with the issues that matter to their customer base, I think we'll see the S of ESG accelerate in terms of the attention it gets and the impact that investors achieve.
So that's really.
Do you think, and this is a slight segue? Sorry, go on, please.
No, I just couldn't help but jump in and say that's the true stakeholder capitalism that we all seek, right? Which is that it is not just about how investors think about things, it's how the entire ecosystem is benefiting or not from what is happening.
Mm-hmm. I mean, this is a slight segue, but obviously we're talking about ESG, and obviously the Ukraine, the Russia's invasion of Ukraine, is one of the biggest stories of our time. But as a very, very small part of that is this question about how and whether ESG investors were caught out by that. in terms of like how people think about the S part of ESG, do we think an event like what we're seeing in Ukraine right now will also prompt people to think more holistically about the ESG footprint of companies and sort of maybe try to, you know, get away a little bit from this box ticking exercise, which a lot of people have criticized ESG for?
I do. I think that it's a real warning sign on, you know, ignoring human rights violations has really come home to roost in the case of Russia.
Yeah.
Like, the signs were all there. We all knew. And yet it was convenient to ignore it, which is fine, I think, for most investors. But if you call yourself a sustainable investor and then you get caught out like that, that's more problematic. So I think it's a really interesting example, and it will be very, very intriguing to see whether it's just a bump in the road or whether it actually does cause sustainable investors to take human rights considerations in other countries across the world more seriously in future.
I think, again, what I would make the point that a lot of these issues are not necessarily new. They're pre-existing for some time, and again, just reflective of what we've seen occur over the last 2 years. It has sensitized and accentuated some of these pre-existing issues. And so we've seen beyond Russia and Ukraine, we've seen, you know, through the health pandemic, just dislocations in the market in terms of employees who have been left very exposed in certain segments of the economy, whether that's the gig economy, whether that's leisure and entertainment. And I think what we're seeing is, again, not just the consumer shifts in behavior, but we're seeing, and at the end of the day, consumers are investors, that will flow through into how they think about their investor preferences as well. And we're seeing a much more a sensitization around these issues, because at the end of the day, as investors, you have a duty to sustain earnings cash flow back to your end investor and shareholder. To the extent these issues are becoming much more pressure points, and they're becoming much more price sensitive than they were historically.
And I would also say that this is an intergenerational shift too, right?
Absolutely.
Sorry, I think Catherine was trying to say something.
Catherine, did you want to get in on that? No.
No.
We are running. We're coming towards the end of our time, but Julie, I'd like to close perhaps with you. You know, again, we've talked about the data, but also it's important to sort of talk about the actionability and what's happening in the real world. You know, proxy season is coming up in the US. In terms of, you know, sectors and parts of the economy, where do you see the most urgent need for investor pressure right now on the S?
Yeah. And so I think, you know, certain sectors, whether that's technology or even within financial services, as well as consumer discretionary, I mean, there we have tended to find patchiness with regards to disclosure of that information. But again, I would underscore, it's not just disclosures, it's one signal. But at the end of the day, you actually have to meet with some of these organizations, whether that's directly or through investor-led coalitions, to really get a sense of that culture and where these issues actually sit at the heart of an organization. And that's very difficult to do on disclosures alone. So you just have to calibrate, I think, all this information.
Mm-hmm.
Great. Well, thank you all so much. Thank you to the audience for watching, and thank all of you, to my three panelists for their time today. That was really interesting. And thank you all very much.